When it comes to personal finance, the word investing might seem intimidating, overwhelming, or just plain unattainable for many people. But the truth is, investing is not just for the wealthy or the financial experts. It's a habit that everyone can develop and benefit from, regardless of their income or knowledge. The good news is that starting to invest doesn't require a huge amount of money or a lot of time and effort. In fact, you can start with as little as $1. Yes, you read that right, just $1. And by doing so, you can set yourself on a path towards building wealth, achieving your financial goals, and securing your future. So why should you invest, and why should you start with just $1? Here are some reasons. First, investing is a way to make your money work for you. When you invest, you're putting your money into assets that have the potential to grow over time, such as stocks, bonds, mutual funds, or real estate. By doing so, you can earn a return on your investment that can be higher than the interest rate on your savings account or the inflation rate. This means that your money can increase in value and purchasing power, rather than just sitting idle in a bank account and lose purchasing power due to inflation. Investing can help you achieve your financial goals, whether that's saving for a down payment on a house, paying off debt, building an emergency fund, or planning for retirement. By investing regularly, even in small amounts, you can accumulate wealth over time and reach your goals faster than you would by just saving or spending your money. Investing can be a form of risk management. While investing always involves some degree of risk, diversifying your investments can help reduce your overall risk and protect your money from market fluctuations or economic downturns. By spreading your investments across different asset classes, industries, and geographies, you can increase the chances of having some assets that perform well even if others don't. Investing is a way to put your money to work for you, allowing you to potentially grow your wealth over time. When you invest, you are essentially buying assets that have the potential to increase in value, such as stocks, bonds, mutual funds, real estate, commodities, gold, silver, and even cryptocurrencies like Bitcoin. Stocks are ownership stakes in publicly traded companies, and they can provide long-term growth potential as companies increase in value and generate profits. Bonds, on the other hand, are debt securities that provide a fixed income stream for investors. They can be less volatile than stocks and can offer stability and income for investors who want to balance risk with return. Mutual funds are a way to invest in a diverse portfolio of stocks and bonds, managed by a professional fund manager. This can help reduce risk and increase potential returns by spreading your investments across multiple assets and industries. Real estate is another option for investors, providing the potential for long-term appreciation and rental income. Owning rental properties can also provide tax benefits and diversification for investors. Commodities, such as oil, gas, gold, and silver, can provide diversification for investors and protection against inflation. They can also provide a hedge against economic uncertainty and geopolitical events, as they are often seen as safe haven assets. Gold and silver, in particular, have been considered valuable assets for centuries and can provide a store of value and a hedge against inflation and economic downturns. They are often used as a safe haven asset during times of economic and political turmoil. Bitcoin and other cryptocurrencies are a newer asset class, offering the potential for high returns but also high volatility and risk. They are decentralized digital currencies that use blockchain technology to secure transactions and provide transparency. While some investors see them as a promising investment opportunity, others are more skeptical due to their speculative nature and lack of regulation. Ultimately, when it comes to investing, it's important to understand the risks and potential returns associated with each asset class, and to choose investments that align with your financial goals and risk tolerance. Diversification across multiple asset classes can help reduce risk and increase potential returns over time. So how can you start investing with just $1? Here are some options. One option is to use a micro-investing app or platform. These are online tools that allow you to invest small amounts of money, usually starting at $1 or less, into a diversified portfolio of ETFs, exchange-traded funds, or mutual funds. Some popular micro-investing apps include Acorns, Stash, Robinhood, and Betterment. These apps often have low fees, user-friendly interfaces, and educational resources to help you learn about investing. Another option is to use a spare change investing app. These apps round up your everyday purchases to the nearest dollar and invest the spare change into a portfolio of your choice. For example, if you buy a coffee for $2.50, the app will round up to $3 and invest the extra 50 cents. Some popular spare change investing apps include Capital, Digit, and Chime. A third option is to invest in a company's direct stock purchase plan, DSPP. Some companies allow investors to buy their stock directly, without going through a broker or paying high fees. This can be a good option if you want to invest in a specific company that you believe in or support. However, DSPPs often require a minimum investment amount and may have limited investment options. Regardless of which option you choose, it's important to do your research and understand the risks and fees associated with investing. While investing can be a great way to grow your money, it's not a guaranteed or risk-free way to make money. You should also have a plan for how much you want to invest, how often you want to invest, and what your investment goals are. In addition to these platforms, many traditional brokerage firms also offer investment options for small amounts of money. Fidelity, for example, offers no minimum investment funds and commission-free ETFs, while Charles Schwab offers a range of commission-free ETFs and mutual funds with low minimum investments. Overall, there are many options for investing small amounts of money, and it's important to choose a platform that aligns with your financial goals and risk tolerance. By starting with just $1, you can begin building the habit of investing and working towards your financial future. This is for educational purposes only and should not be taken as financial advice. The information provided is not intended to be a substitute for professional financial advice. Please consult a financial professional before making any financial decisions. Please, comment, like and subscribe.